Good afternoon, ladies and gentlemen. We are Group 8 that comprises of Mr. Pelokgale Ramaribana and Mr. Modiri Mantswe. Unfortunately, one of our team members couldn't be part of us due to other reasons. We are analyzing the Chobe Holdings Limited financial performance for the financial year 2023 2024. The presentation will be laid out in this manner. There will be the introduction by myself into the financial performance analysis. The liquidity ratios and the efficiency ratios will be taken through by Mr. Ramaribana, leading to the discussions and recommendations and conclusions by Mr. Mantswe. Introducing the company Chobe Holdings Limited. It was founded in 1983. It mainly operates in ecotourism industry, hospitality around the Okavango Delta. In 1983, it owned only one lodge, and it has grown and expanded, currently owning up to 14 state-of-art lodges and hotels across Botswana, Namibia, and Zambia. In terms of profits, over the past 5 years, it has recorded more than 239% increase in net profit. So you'd realize that the company has grown over the years. The purpose of this report, basically to you, the management, is to give you an indication of where the company is, so as to facilitate effective decision making, so you can manage and monitor as well as evaluate the financial performance of the company. Lastly, we'll give recommendations on how Chobe Holdings Limited would continue to be profitable and maintain an upper edge on competitors, thus attracting more investors. The financial performance analysis will start by the profitability ratios. Here we have two. The rate on capital investment, ROCE, as indicated by the far end bars. From the year 2023 into 2024, recorded an increase that could be attributed to an increase in generated operating profit. Also, it suggests there was less borrowing and maximization of profit. This indicates that the business is less risky, as indicated by Houston and Braham 2002. The other ratio is the gross profit margin, that has also increased from 2023 into 2024. This also could be attributed to it indicates an improved direct cost control within the company, and suggests an effective procurement strategies or pricing power. Thank you. I will hand over to my colleague.
Good afternoon. We will be continuing our presentation. We continue with our probability ratio. The next ratio under probability, we looked at net profit margin, which indicates how Chobe Holdings Limited efficiently converts sales into profit, calculated after covering all cost and expenses. The NPM increased by 2%. If you can look at the middle column there, it increased by 2%. It was 25% in 2003. Then it continued to be 27 in 2024. And the simple question is, what does that imply? It implies that the company managed non-operating costs well, for instance, interest and taxation. And then what does that reflect? According to Drury, this reflects an upward trend in profitability and operational efficiency. We also looked at the other ratio being efficiency ratio. So efficiency ratio evaluates how effectively a company like Chobe Holdings utilizes its resources to generate revenue and manage its operations. Essentially, the ratios, we were checking the health check of the company operation processes. So we looked at the asset turnover ratio. Asset turnover ratio asset turnover ratio are the assets being used or they remain idle. So the ratios for both years, if you can see, they are below 1, indicating low assets turnover, inefficiency utilization of available assets. However, asset turnover increased in 2024 as a result of the increased revenue. Utilization of available assets increased. So we also looked at the inventory turnover. So primarily the inventory turnover uses inventory turnover primarily is used to assess how efficiently a company manages its inventory or stock. Chobe Holdings efficiently managed its inventory. This means that in 2024, the services were sold faster than in 2023. Generally, inventory at Chobe Holdings is managed efficiently. The next ratio that we looked at is the liquidity ratio. So liquidity ratio assesses a company's ability to meet short-term obligations. So we looked at the quick ratio, which measures the ability to meet short-term debts without using the most liquid assets. So ratios for both years are above 1.0, indicating strong liquidity. So the company could pay short-term debts. However, there is a decline in 2024 as a result of increased current liabilities and inventories. So we also looked at the current ratio, which points to whether a company has enough short-term assets such as cash to cover its short-term liabilities such as short-term loan. Chobe Holdings may struggle to pay short-term loans as the ratios, they are below a threshold of 1.5. So a decline of 0.1 recorded in 2024, which is linked to an increase in current liability by 26.9%, which may place a strain on the liquidity in the long-term run. This call for proactive working capital management. So now I'll hand the baton to my colleague Modiri Mantswe for the last segment of our presentation. Thank you.
Okay, thank you, Mr. Ramaribana. Mine is an easy one. It doesn't have a lot of numericals. It's just in a narrative format. I'll be talking about the strategic implementations. So the implementation process is turning maybe the strategy into an action plan. Chobe Holdings Limited's 2024 performance reflect commendable revenue growth, marginal expansion, and asset efficiency. So there isn't really that much of the strategies because it can be more like the work well done. So, but therefore, they have to be vigilant in terms of managing the costs or unnecessary expenses. So, however, declining liquidity metrics and reducing operation cash flow requires strategic attention. It is vital for Chobe to align its financial structures with operational growth trajectory. The company's reliance on current liabilities may threaten future solvency if managed alongside rising inventory and receivables. That's from Cornish there. It's 2024. That's a bit of a mistake there. Sorry, thank you. Then I'll go to recommendations. The recommendation, these are just suggested actions in terms of maybe solving the problem. The first recommendation there is to continue maintaining competitiveness in the hospitality market by strengthening the liquidity control, inventory optimization, utilizing the just-in-time or the GIST. It's popularly known maybe in the fast food restaurant for like the example of pizza. So where you don't keep much of inventory there. Second one, it will be improve capital efficiency. You reinvest the excess cash into productive assets or repay expensive short-term debts. You put profit back into the business there. And the third one, leveraging on technology. Automate the inventory and procurement process to reduce inefficiencies and support real-time decision-making. The last one there is reevaluate the financial structures, reduce dependency on short-term liabilities, and by exploring long-term financial options. Okay, conclusion there as we wrap up our conclusion. Chobe Holdings Limited has shown commendable performance in financial performance between 2023 and 2024, particularly in profitability and efficiency. This attributes to efficient management and strong financial health. However, liquidity pressures and cash flow constraints present emerging risks. Strategic improvement in working capital management, operational cash flow monitoring, and capital structure are essential to sustain and maintain the company's growth. By continuously improving this area, Chobe Holdings Limited can efficiently utilize the assets. That was the more or the less that we prepared for you today, and those are our references there. And thank you. I will now entertain any comments or questions if there is any.
Yes, thank you, Mr. Mantswe. Let me commend you for a clear voice projection. Moving to my question, what is the impact if you are to increase return on capital employed?
Okay, that one I think my colleague will be in a better position to clear it off.
Thank you for the question. The increase in ROCE would suggest an improved capital utilization. Also, it would suggest a high return on the company investment. It is an indication of, less borrowing but maximizing on the profits, and it will lastly indicate that the investment is of less risk. Thank you.
Thank you so much for that clarity, Mr. Tshukudu.
Any more question? Yes, sir.
Thank you for the opportunity. Under your recommendations, I heard you talk about the leveraging through technology. Can you elaborate further how Chobe Holdings can leverage?
Thank you for the question. Let me pass it to one of my colleagues.
Okay, thank you for the question. That's a good observation. Thank you. It's a brilliant question, by the way. But we are living in at the moment, this is industrial, the fourth industrial revolution. We're talking about digital technology. So we have to employ one of those. There is the AI, now there is the IoT, which is maybe the Internet of Things. Then there is the robotics and automations. So we have to employ maybe some of the ERPs, which is the enterprise resource planning, just to address the issue of inventory there. So I think with that, we'll just have to tap into the digital world we are living in. Thank you.
Wow.